The information provided in this video is for general informational and educational purposes only. It is not intended as professional financial or investment advice. Always seek the advice of a qualified financial advisor with any questions you may have regarding your personal financial situation or investment decisions. The creator is not liable for any errors or omissions, or for any losses or damages you may incur as a result of relying on this content. Past performance is not an indicator of future results. Do your own research.
As we begin 2026, the dominant headline for Tesla is the official loss of its global EV sales crown. On January 2, 2026, Tesla released its Q4 2025 production and delivery numbers, revealing a difficult end to the year. Tesla delivered 418,227 vehicles in Q4, a 15.6% decline compared to the same period last year. For the full year 2025, deliveries totaled 1.64 million, marking an 8.6% drop from 2024. This confirms that Chinese rival BYD has officially surpassed Tesla as the world's largest electric vehicle manufacturer, having sold nearly 2.26 million battery electric vehicles, BEVs, and 4.6 million total units, including hybrids, in 2025. The primary driver of this decline was the tax credit cliff in the United States. The expiration of the $7,500 federal EV tax credit in September 2025 pulled demand forward into Q3, leaving Q4 with a significant sales vacuum. In contrast, competitors like Rivian and Kia managed to maintain steadier footing through aggressive leasing incentives that bypassed some purchase credit restrictions, though Rivian still faces cash burn challenges. In Europe, Tesla's market share has eroded sharply. While the Model Y remains popular in Norway, sales in key markets like France and Germany have plummeted due to the removal of subsidies and fierce competition from legacy automakers like BMW and Volkswagen, who have refreshed their EV lineups with more affordable options. Despite the delivery miss, Tesla stock has remained surprisingly resilient, trading in the $440 to $450 range. This divergence between falling car sales and a stable stock price highlights the market's shift in perception. Investors are no longer pricing Tesla as a car company, but as an AI and robotics play. Meanwhile, legacy competitors like Ford and GM have seen their stocks rally recently as they pivoted back toward high-margin hybrids and trucks, capitalizing on the cooling pure EV demand that is hurting Tesla. Tesla's financial profile in early 2026 presents a stark contrast to the rest of the automotive industry, reflecting a valuation entirely decoupled from current automotive fundamentals. P/E ratio, price-to-earnings. Tesla is currently trading at a staggering 300x to 313x earnings. This is a massive expansion from its 12-month average of 192x, largely because earnings, the denominator, have collapsed while the share price has held up. For comparison, Toyota and GM trade at traditional auto multiples of 9x, 15x, and even tech-heavy BYD trades at a much more rational multiple given its volume dominance. P/B ratio, price-to-book. Tesla trades at roughly 18.9x its book value. This implies investors believe Tesla's intangible assets, brand, AI software, data, are worth nearly 19 times its physical assets. In contrast, legacy automakers like Ford often trade near 1.0x, 1.5x, reflecting heavy asset bases and lower growth expectations. PEG ratio, with earnings growth negative in 2025, profits fell as margins compressed. The PEG ratio is currently undefined or negative. Historically, a PEG under 1.0 is undervalued. Tesla's effective PEG is astronomically high, signaling that the market is pricing in an explosion of future growth from non-automotive sources that has not yet materialized. Return on equity, ROE. Tesla's ROE has compressed to roughly 1.75%, a far cry from the 20% plus figures seen in its prime growth years, 2021 to 2023. This is now lower than Toyota, approximate 10 to 12%, indicating that capital efficiency in the core car business has deteriorated significantly due to factory underutilization and price cuts. Debt to equity, D/E. This remains Tesla's fortress. The company maintains a pristine D/E ratio of 0.17, far superior to Ford and GM, which carry heavy debt loads to finance their pension liabilities and factory retooling. This fortress balance sheet is what protects Tesla from bankruptcy risk during this sales downturn, a luxury that smaller competitors like Rivian and Lucid do not possess. Valuing Tesla in 2026 requires choosing between two distinct realities: the current cash-generative car business, bearish, or the future AI optionality, bullish. Discounted cash flow, DCF strict financial models paint a grim picture. A standard DCF analysis, inputting Tesla's 2025 free cash flow of $6.4 billion and assuming a generous recovery to 15% growth, yields an intrinsic value between $75 and $155 per share. With the stock trading over $440, these models suggest Tesla is overvalued by 80% to 160%. The market is currently adding a massive AI premium, roughly $300 per share, that cannot be justified by vehicle sales alone. Comparison: if you run a similar DCF on BYD, the stock often appears undervalued or fairly valued, as their cash flows track closely with their market cap. Tesla is unique in trading on Stage 2, future, cash flows rather than Stage 1, current, ones. Dividend discount model, DDM. The DDM is not applicable to Tesla because the company pays no dividends and has given no indication of starting one. Tesla reinvests all capital into its high-growth ventures, AI clusters, Optimus robots. Comparison: this is a key differentiator for income investors. Ford, GM, and Mercedes-Benz pay healthy dividends, often yielding 4 to 6%, making them valid targets for DDM valuation. Investors hold these stocks for steady income, whereas Tesla holders are purely chasing capital appreciation. The lack of a dividend creates a floor-less risk. If the growth story breaks, there is no yield to support the stock price. Implied valuation: to justify the current $440 plus price, you must assume Tesla will not just recover, but dominate entirely new industries. The valuation implies Tesla will generate software-like margins, 30% plus, on hardware products, robots/robot axis, by 2030. If you believe Tesla is just a car company, the stock is mathematically broken. If you believe it is an AI monopoly, the DCF is irrelevant. Beyond the numbers, the story of Tesla has shifted dramatically in the last 12 months. Management and focus. The key man risk regarding Elon Musk remains the single biggest qualitative factor. In 2025, we saw a significant executive exodus, with key leaders like Drew Baglino, Powertrain, and Omiad Offshore departing. This has left Musk with a leaner, less experienced inner circle. Furthermore, Musk's split attention between Tesla, SpaceX, and his AI venture xAI continues to worry institutional investors. There is a persistent fear that the best AI talent is gravitating toward xAI rather than Tesla. Brand perception: Tesla's cool factor has diminished. The Model 3 and Y are now ubiquitous, reducing their status symbol appeal. The Cybertruck, while polarizing, has seen sales fade after the initial reservation backlog cleared, failing to become the mass-market hit the Model Y was. In contrast, Rivian has successfully maintained a premium, adventure lifestyle brand image that Tesla has lost, and BYD has successfully branded itself as the pragmatic, value-for-money king globally. The AI pivot: Tesla has effectively rebranded itself to escape the low-margin trap of auto manufacturing. The narrative is no longer about selling 20 million cars, a goal that has quietly disappeared from mission statements, but about solving autonomy. This pivot is risky but necessary. If Tesla is viewed as a tech company, its stagnation in car sales is forgivable. If the market decides the AI pivot is a distraction to hide slowing growth, the sentiment could collapse overnight. Regulatory moat: one qualitative advantage Tesla retains is its data lead. However, regulators in Europe and the US are tightening scrutiny on FSD, full self-driving claims. Meanwhile, competitors like Mercedes, with Level 3 certification, and Waymo, Robot Axis, are winning the regulatory race, even if Tesla wins the data race. Tesla's valuation is propped up by several smaller bets that are expected to become massive revenue streams. Optimus, humanoid robot. This is Musk's new favorite child. As of early 2026, Tesla has deployed thousands of Optimus Gen 2.5 units inside its own factories for tasks like battery cell sorting. Musk claims this business alone will eventually be worth more than the car business. While competitors like Boston Dynamics, owned by Hyundai, and Figure AI exist, Tesla's advantage is manufacturing scale. The target is to ship units to external customers by late 2026. Energy storage, the quiet winner while cars struggled. Tesla Energy had a blowout 2025. The division deployed a record 14.2 GWh of storage in Q4 alone. The Megapack business is on track to generate $20 billion in annual revenue with margins often higher than automotive. This is no longer a small bet, but a primary pillar of the company, providing a financial safety net that competitors like Lucid or Rivian lack completely. Dojo versus Cortex. In a significant pivot, Musk effectively declared the original Dojo supercomputer project an evolutionary dead end in late 2025. Resources have shifted to the new Cortex supercomputer cluster in Austin, powered largely by NVIDIA H100/B200 chips rather than Tesla's custom silicon. This admits a defeat in chip design but ensures Tesla remains competitive in training its FSD neural nets. FSD licensing. Tesla is currently in talks with two major OEMs to license its FSD software. If successful, this would be the Android moment for Tesla, high-margin software revenue without the cost of building cars. However, no deal has been signed yet.
The divergence between the bull and bear cases in 2026 is wider than it has ever been. The bull case target $1,000 plus $3T market cap bulls, led by analysts like Dan Ives and Cathie Wood, argue that looking at P/E ratios is a mistake. They view Tesla as a sleeping giant in AI. Robotaxi unlock. They believe the declining car sales are temporary and irrelevant. The real value lies in the Cybercab fleet, which they expect to launch fully in 2027, unlocking $1 trillion high-margin taxi business. Energy boom. The energy grid is desperate for storage to support AI data centers. Tesla is the only company with the manufacturing capacity to meet this demand, potentially doubling energy revenue again in 2026. FSD monopoly. Bulls believe the end-to-end neural net, V13/V14, solves autonomy. Once licensed, it becomes the standard operating system for all cars, similar to Windows for PCs. The bear case target, $150/$500 billion market cap. Bears argue that the emperor has no clothes. They see a car company with shrinking sales trading at 300x earnings. Valuation reality check. Bears point out that even if Tesla succeeds in AI, it is already priced as if it has succeeded. Any delay in Robotaxi or Optimus will cause a massive multiple compression. Competition is winning. BYD has won on volume. Luxury brands are winning on quality. Tesla is squeezed in the middle with an aging lineup. Model Y is now 6 years old in design. The hollow growth. Bears argue the AI pivot is a smokescreen to distract from the fact that organic demand for Tesla vehicles has peaked. Without a new, low-cost Model 2, which has been delayed indefinitely, there is no catalyst to restart volume growth.